Wall Street cheered. The headlines screamed victory, but behind the numbers, a multi-billion-dollar deception was playing out. The truth was hidden in plain sight.
GM reported profits plunged 57%. They blamed a $1.6 billion EV charge, and the market loved it. The real story? Tariffs have gutted $3 billion from their bottom line. The EV charge is nothing more than a smokescreen.
Ford also had their quarterly earnings call this week, and they used the word tariff 37 times in 55 minutes. That's once every 90 seconds. And hidden right there in plain sight, the real story is Ford setting aside $500 million in preparation for loan defaults.
Wall Street's cheering for a fantasy. The data proves it. The Great Squeeze is giving way to the domino theory. Welcome, welcome, welcome. This is your host, Josh Logan, and you are listening to Confessions of an Insider. This is the place where automotive strategy meets market reality, the ASMR edition. As you just heard, the story Wall Street bought this week was a fantasy. The real story, hidden in the data from Detroit's earnings report and the latest inflation numbers, is one of immense pressure. We're talking about the crushing weight of tariffs acting as the primary driver of the Great Squeeze on manufacturers, happening in an economy where policy shifts daily. And the consequences? They are the domino effect we've been tracking, now showing up not just in bankruptcies, but inside the balance sheets of Ford and GM themselves. Let's break down the corporate proof, starting with General Motors.
Okay, so General Motors Q3 2025 earnings, it really presented quite the paradox for investors, didn't it?
It really did. You saw the stock initially jump, 15%? Looked good on the surface.
Right, suggesting everything was fine. But for those of you, digging into the actual financials, the picture was, well, a lot more complicated.
Exactly. And that's what we want to do today, get past that headline pop and find the real data-driven story.
Because the big number, net income, it didn't just slip, it crashed. Down 57% year over year. That's massive.
It is. And you just have to ask yourself, if the stock's up, what drove such a huge drop in actual profit?
Okay, let's start with GM's official line. They pointed to this enormous $1.6 billion special charge.
Right. Labeled EV portfolio actions.
That sounds very corporate. What does EV portfolio actions actually mean in plain English?
Yeah, it's peak corporate speak, isn't it?
Yeah.
Look, what we need to translate for you is that this is basically the sound of slamming on the brakes. Hard. It's the cost of cleaning up. Canceling EV models they'd planned but now realize aren't going to work or maybe aren't viable anymore.
And paying suppliers.
Well, and pay suppliers, yeah. We're talking 9-figure penalties sometimes for battery contracts, component contracts that are now essentially worthless because the strategy shifted.
Wow. $1.6 billion just for that. I mean, you can feel the pain in that number. It's such a tangible, almost brutal symptom of how tough this EV transition really is.
It really is. It's like the cost of stepping on the first landmine, you could say. A very expensive mistake, or maybe a necessary correction, but costly either way.
But you're saying that as big as that $1.6 billion is, it might be a bit of a scapegoat.
Well, maybe not entirely a scapegoat. It's real money, but it risks masking a deeper, maybe more persistent issue. You have to look at the year-to-date figures.
Okay, let's do that. What are the numbers telling us?
Over the first 9 months of 2025, GM's net income dropped almost $3 billion, $2.96 billion to be precise, compared to the same period last year.
Nearly $3 billion? Okay.
Now, connect that to what GM themselves have been saying. They estimated the full-year hit from tariffs would be somewhere between $3.5 and $4.5 billion.
Right, I remember that estimate.
So here's the kicker. That nearly $3 billion year-to-date profit drop. It almost perfectly aligns with the prorated impact of those tariffs.
Wait, so you're saying the entire year-over-year profit deficit, pretty much all of it, could just be tariffs?
Essentially, yes. The math suggests that the relentless financial drain from tariffs can explain the whole gap. If you took that anchor away, the year might look, well, not great because of the EV charge, but much closer to normal.
So the EV charge is the big sudden bang that grabs headlines. But the tariffs are this quiet, constant, multi-billion-dollar bleed happening in the background.
That's a perfect way to put it. A catastrophic bleed, really.
Okay, so even with all this red ink, GM is still out there saying its EVs are variable profit positive. That phrase sounds carefully chosen. What's it leaving out?
Oh, it's very carefully chosen language, designed to sound positive, right? So simplifying it, variable profit positive basically means if you only look at the direct cost of the physical parts, the battery cells, the metal, the immediate labor to assemble that specific car, then yes, they're selling it for more than those parts cost.
Okay, so materials and assembly line work.
Right. But crucially, it completely ignores the billions with a B they've sunk into R&D for those EVs, building the new factories, retooling old ones, plus all the marketing dollars.
Got it. So they might make a tiny bit on the parts in each EV sold, but the overall EV program itself is likely still hemorrhaging cash when you factor everything in.
Precisely. The program profitability is a whole different and likely much bleaker story right now.
So with billions burning on EV strategy shifts and billions more draining away because of tariffs, what's actually keeping the lights on? Where's the stability coming from?
It comes back to the old guard. The lifeline is the traditional internal combustion engine business.
The trucks and SUVs.
Exactly. Those incredibly high-margin cash-printing machines, your Silverados, your Tahoes, your Suburbans, that core ICE business is what's funding this incredibly expensive EV transition and offsetting those massive tariff losses.
Okay, so that leads to this idea you mentioned, the great squeeze.
Yeah.
But hang on, isn't every big transition kind of funded by the old product line? Why is this situation at GM so special it gets that title?
That's a fair question. I think it's the sheer severity and the speed of it all happening at once.
Okay.
They aren't just managing a transition, they're doing it while simultaneously fighting this multi-billion-dollar external assault from tariffs and cleaning up a very public, very expensive mess from their previous EV strategy.
On two fronts.
Exactly. It's forcing the profitable past, the ICE business, to fund this volatile, expensive future, the EVs, but under this immense dual pressure. That pressure cooker situation, that's the great squeeze. It's exponentially harder than just a standard product transition.
Yeah, that makes sense. This report really is a sobering reality check, isn't it? It paints a picture of GM fighting a war on two very expensive financial fronts.
It really does. The messy $1.6 billion EV cleanup on one side and this relentless multi-billion-dollar tariff assault on the other.
So what's the final takeaway for someone trying to understand the auto industry right now?
Well, I think it shows just how messy and frankly chaotic the road to electrification is proving to be for these legacy automakers. It's not smooth. This GM report exposed some deep financial wounds.
And it makes you wonder about the competition.
Absolutely. It raises a really important question. How is GM's big rival, Ford, navigating this exact same treacherous environment? Their earnings are coming up soon.
Right.
We really need to watch that closely. It'll give us crucial perspective on whether these immense pressures are just a GM problem or if they're truly hitting the whole industry this hard. Definitely something for you to keep in mind as we wrap this deep dive.
Profits down 57%? But the stock pops 15%? Why? Because GM successfully used that $1.6 billion EV restructuring charge as a smokescreen. Our analysis showed the real hit. The $3 billion elephant in the room was the ongoing cost of tariffs. They hid the pain caused by external policy pressures behind the narrative of internal EV restructuring, a masterful piece of corporate spin. But their crosstown rival couldn't play the same game. Ford reported just 2 days later. They faced the same tariff headwinds, the same EV cost pressures, and the impact of the recent fire. But their report told a much different and far more honest story.
All right, let's dig into this Ford Q3 2025 earnings report. Our mission today, well, it's pretty simple. You saw the headlines, the big Wall Street reaction, but we want to look past that initial celebration. We're going to find the critical financial details that, frankly, seem to get ignored. And yeah, what a celebration it seemed like at first. Ford posted, a solid revenue beat, up 9% to $50.5 billion. That news sent the stock flying up over 12% in just 2 days. It jumped from, $12.32 before earnings up near $14 afterwards.
Big move.
Big move, yeah. But that euphoria might be built on, let's say, a bit of a revenue mirage, right? Because the data, when you look closer, it really confirms some deep structural weaknesses hiding under that top line number. And we know this because Ford itself basically confirmed a huge strategic retreat. Management cut their full year profit guidance. That kind of concession, well, tells you the real story is probably darker than just the sales figures suggest.
Wait, hang on. So even with revenue beating expectations, the actual the core profitability is collapsing. Is that what you're saying?
Exactly. That's the crux of it. When we look beneath that shiny revenue number, okay, Q3 sales were up, sure, but their adjusted EBIT, that's their operating profit, it was flat compared to last year. And actually, it gets worse. Their adjusted EPS, earnings per share, that actually declined. So yeah, they're selling more stuff, more cars, but the profit they make on each sale, it's just evaporating.
Flat EBIT, declining EPS, while revenue is up. That points to serious pressure. How bad does it look when you zoom out, like year to date?
Oh, it's brutal year to date. The net income numbers really show the damage. It's fallen sharply from $4.1 billion this time last year down to just $2.9 billion for the first 9 months of 2025. That massive collapse, I mean, that's what forced them. They had to cut their full year adjusted EBIT guidance, dropped it from $7.5 billion down to a new lower range, $6.0 to $6.5 billion. They essentially just waved the white flag there, admitting the squeeze as well. It's overwhelming them.
Wow, okay. $1 billion or more just vanished from their profit forecast. So what did they point to? What was the main reason they gave for this huge profit bleed? I remember listening to the call. I was actually shocked how specific they got about one thing.
Yeah, Ford's leadership was incredibly clear on this. External costs. Specifically, they detailed a $700 million hit just from tariffs. Just think about that $700 million wiped out purely because of, border costs and these ongoing trade issues.
And didn't they mention tariffs like a lot on the call?
They did. It really underscores how central this is. The word tariffs, get this, was mentioned 37 times in about 55 minutes on their earnings call. 37 times.
Okay, $700 million from tariffs alone. That kind of external hit must be absolutely crushing their margins on the factory floor, right?
It is. You can see it directly in the margin compression. The year-to-date automotive EBIT margin, well, it's looking dangerously thin now. It dropped from 5.9% in 2024 down to only 4.1% so far in 2025. That confirms the manufacturing side of this, what we're calling the great squeeze. It's right there in the P&L.
So they've got this huge external cost pressure.
Yeah.
But you mentioned finding something maybe even more alarming, something hidden away in the Ford credit division, like a canary in the coal mine for the consumer.
That's right. It's the credit loss provision. It's kind of buried in the Ford credit financials, but it's critical. This isn't some abstract accounting thing. This is the actual money Ford is putting aside because they expect their own customers, people buying F-150s, Broncos, Explorers, they expect them to default on their car loans. It's basically Ford's internal warning system flashing red about consumer distress.
And you said that number didn't just tick up slightly, it exploded.
Exploded is the right word.
Yeah.
That provision, it spiked. It went from $323 million in the second quarter of 2025 up to a massive $477 million in the third quarter. That's almost $500 million set aside in just one quarter because they anticipate loan defaults. This is Ford's own data confirming they're bracing for a significant wave of customers running into financial trouble.
Okay, so let's piece this together for everyone listening. Ford seems trapped, right? Caught between these two massive forces. On one side, you have $700 million in external tariff costs just eating away at their profits. On the other, you have their own customers showing signs of serious financial stress, forcing Ford to set aside nearly $500 million for expected defaults.
Exactly. And that's the core disconnect that's so stunning here. The company's profits are clearly getting gutted. They're actively preparing for, a wave of customer bankruptcies or defaults. And yet the stock market, initially anyway, just celebrated the superficial revenue beat, ignoring these huge flashing warning signs. That loan loss provision number, that $477 million, that's tangible proof, internal proof from Ford itself that the fundamental health of their end consumer is deteriorating. So the final thought for you is this. If a major automaker's own internal data is confirming this level of consumer squeeze, well, what broader economic assumptions should maybe you be questioning right now?
Ford laid it bare. They admitted the tariff pain, cutting guidance by over $1 billion. They showed the staggering losses in their EV division, but the most crucial piece of data, the smoking gun, was Ford Credit setting aside nearly $500 million because they expect their own customers to default on loans. They are telling us directly that the consumer is breaking. This isn't a forecast. It's happening now, and the latest inflation data backs them up. After the auto titans released their quarterly earnings, Friday, we got the September Consumer Price Index. While Wall Street focused on the headline number, the details inside the auto sector painted a grim picture for the average car owner.
So, Wall Street seemed pretty happy today. Woke up to headlines celebrating that September CPI report.
Yeah, happy is one word for it. They got the number they wanted. Overall and core inflation both landing at 3.0% year over year.
Looks neat.
Looks very neat. Tidy package.
But look, for anyone who actually needs a car to, get to work, run errands, live their life, that 3.0%, it's kind of a statistical mirage.
A mirage, okay.
Yeah, it completely hides the severe financial pain that households are feeling right now, especially if they rely on that vehicle.
Right. Okay, so that's what we need to dig into today then. This deep dive is about pulling that mask off, looking at what we're calling the great squeeze.
Exactly.
The reality that's tightening its grip on American car owners. Because for you listening, your personal inflation rate, if you drive, it's probably fundamentally different.
We really have to stress this right off the bat. The essential costs, the ones you absolutely cannot avoid if you own and operate a car. They are just dramatically outpacing that 3.0% average everyone's celebrating.
Dramatically outpacing. Yeah, and that gap, that's where people are hitting a financial breaking point.
Okay, but wait, why is it so much worse? I mean, if the general trend for inflation is slowing down, what specific things in the data are hitting so hard? What's the gut punch here?
Well, there are two really undeniable financial gut punches confirmed in this September data. The first one is just relentless. Motor vehicle maintenance and repairs.
Okay, stuff you can't put off.
Exactly. It's not discretionary.
Yeah.
If the car breaks, you have to pay. And that category is soaring. I mean, a massive 7.7% year-over-year increase.
Whoa, okay, 7.7. That's more than double the headline rate.
More than double. And that number alone, honestly, it should terrify anyone lending money in the auto space.
Yeah, you'd think so. Okay, what's the second punch?
The second unavoidable cost, gasoline. Now, the year-over-year number looks kind of flat, slightly down maybe, but families don't budget gas annually, right?
No, you feel it right now at the pump, week to week.
Exactly. You feel the immediate hit. And in September alone, gas prices just exploded by 4.1% month over month.
4.1% in just 1 month.
Yeah. That jump is immediate painful damage to cash flow for millions of commuters. Just drains the wallet right away.
Okay, so we've got the shock of potentially huge repair bills, that's 7.7%, and then the constant drain at the pump, spiking 4.1% just last month. But this squeeze idea, it's not just about those massive spikes, is it? It's also about the pressure from things that just aren't getting cheaper.
That's a really critical piece of context.
Yeah.
You have to look at things like used cars and trucks. Okay, sure, they dipped to like 0.4%, 0.4% month over month in September.
Which sounds good, maybe. A little relief.
But it's basically statistical noise. It's not real relief.
Yeah.
Because they are still up a significant 5.1% year over year. That pressure hasn't gone away.
Still way above that 3.0% average.
Way above. And motor vehicle insurance, it's the exact same pattern. Still up a painful 3.1% year over year. Again, outpacing the headline rate, even if it wiggled down slightly month over month.
So the squeezes, it's these essential costs, repairs, gas, used cars, insurance, all rising much faster than the average, forcing really tough choices.
That's the definition. The inescapable, non-negotiable costs are rising far faster than average inflation. It forces impossible choices on consumers.
Mm-hmm.
What do you cut when you need the car to earn money?
And what's fascinating, I think, is how the CPI data, these specific numbers, they start being just abstract statistics and they start explaining actual crises we're seeing in the industry.
Precisely. That huge 7.7% jump in repair costs we talked about, that's not just an inconvenience for someone.
Right.
For a borrower, especially someone with a subprime loan, that's often the financial shock that pushes them into default.
Yeah.
It wipes out whatever buffer they might have had.
So this data is kind of the macroeconomic proof, the why behind the collapse of some of those subprime auto lenders we saw fail recently, like First Brands and Primalend.
Absolutely.
Yeah.
It provides that context. They weren't just victims of, say, bad underwriting alone.
They were victims of their customers running out of money.
Their customer base literally ran out of money to cover the essential costs of keeping the car running. And this stress, It also creates real tension for the big automakers, right? Think about GM or Ford.
How so?
Well, their profit centers are often high-margin trucks and SUVs. But those become an untenable luxury, something people just can't afford when the potential buyers are facing these massive, unexpected repair bills or soaring insurance premiums.
Right. The math just doesn't work anymore for the consumer.
The math breaks down.
Okay, so let's summarize the core takeaway here. The Great Squeeze, it's not some temporary blip. It feels like a persistent, grinding reality, and the September data confirms it. The essential costs tied to owning and driving a car are just drastically outpacing that celebrated average inflation rate.
Yeah, and that raises a really important question, I think, for everyone tied to the auto sector, from lenders to dealers to manufacturers. Do not be fooled by the 3.0% headline number.
Look deeper.
You have to look deeper. The costs that inflict the most pain, the most essential costs of driving, they are continuing to drive serious financial stress for millions of people.
So our final provocative thought for you, listening. This report really seems to confirm that the consumer is, in many ways, being financially suffocated by the very vehicle they absolutely depend on just to live and work. So what happens? What happens to the broader economy when these essential costs of life start to break the weakest links in the financial chain?
Insurance costs finally cooled slightly month over month. But the real story? Maintenance and repair costs surged again, up nearly 8% year over year. This is the Great Squeeze hitting the consumer directly in their wallet, making it harder to afford the car they already own. It's the exact pressure that forces lenders like Ford Motor Credit to brace for defaults. It all connects. And that brings us to the week's main event, where we tied all the threads together. We took the GM report, the Ford report, the CPI data, and the context of the ongoing tariff war against the world, and we laid out the full picture in our Saturday expose.
Okay, let's dive in. We've gone through the Q3 2025 earnings for GM and Ford, and wow.
Yeah. It's not your typical quarterly report story, is it?
Not at all. What we found looks like a major crisis. We're calling it the Great Squeeze.
Right, and it seems to be driven by these huge tariff pressures, like billions of dollars hitting them.
What really stood out is how differently GM and Ford presented, essentially the same problem.
Exactly. It was night and day. You had GM kind of trying to manage the narrative, maybe.
You could say that, and Ford.
Ford seemed cornered, like a forced confession almost. The data really shows who was hiding what.
So let's start with GM. They came out, reported lower profits, and immediately pointed to one thing, right?
And a very neat $1.6 billion EV restructuring charge.
And the media, Wall Street, they just grabbed that.
Oh, yeah. It was the easy explanation. Simple headline. Job done.
But digging into their actual 9-month numbers tells a different story.
A very different story. That $1.6 billion, it feels like a distraction, a smokescreen.
Because the real hole is bigger.
Much bigger. Look at their net income over 9 months. It's down almost $3 billion. $2.96 billion, to be precise.
Okay, nearly $3 billion. And what about EBIT adjusted, that core operating number?
That's down $2.52 billion. Before interest and taxes, their main business took a $2.5 billion hit.
So you're saying the actual profit shortfall is, what, closer to maybe $3.5 billion?
Exactly. Somewhere in that $3 to $3.5 billion range seems, more accurate based on the trend.
And how does that number connect to the tariffs?
Well, that's the kicker, isn't it? That range, $3 to $3.5 billion, it lines up almost perfectly with GM's own earlier estimates for the full year tariff impact.
They'd predicted $3.5 to $4.5 billion for the year from tariffs.
That's right. So this hole we see opening up, it matches the tariff bleed they expected.
Meaning the $1.6 billion EV charge wasn't the cause of the profit drop?
It looks much more like the cover story for the tariff damage. It explains part, but not the whole picture,
Okay, so GM spins a story. Then Ford reports just a couple of days later.
And Ford basically confirmed the pressure was real and massive. They couldn't use the same kind of accounting cover.
Why not? Just different structure.
Yeah, partly financial structure, reporting differences. They were pretty much forced to admit they were cutting their full-year profit guidance.
By how much?
Over $1 billion. A straight cut to the outlook.
And they were specific about why.
Oh, very specific. We analyzed the earnings call transcript. The word tariffs mentioned 37 times.
37 times. Wow.
Mm-hmm. They weren't hiding it. That kind of reluctant honesty from Ford, it really confirms the scale of this external squeeze on the whole industry.
So, okay, the manufacturers are getting squeezed hard by tariffs. Billions in lost profit. Who's next? Where does that pressure go?
Well, that's the really concerning part we found buried in the data. It looks like it's starting to hit the consumer domino, as you put it.
How so? What's the evidence there?
First, you have background context. Remember the September CPI report, the inflation numbers.
Vaguely. What was relevant?
Motor vehicle maintenance and repairs. Already up 7.7% year over year.
So just keeping your current car running is getting significantly more expensive.
Exactly. That's the background pressure. People are already feeling a pinch there.
But was there something more direct in the Ford or GM reports? Like a smoking gun?
Yes. Hidden deep inside Ford Credit's financials. Ford Credit, they finance millions of car purchases.
One of the biggest auto lenders out there. What did their numbers show?
Their provision for credit losses. That's the money they set aside because they expect people won't be able to pay back their car loans.
They expect defaults.
Right. And that number, it exploded, jumped up to $477 million in the quarter.
Nearly $500 million set aside just for expected defaults in one quarter.
Yes. That's not a forecast about the economy in general. That's a major lender looking at their own customers and actively bracing for a wave of defaults.
So the squeeze isn't just theoretical anymore, it's showing up in the lender's risk planning.
It's a financial reality baked into their books now. They see the stress on the consumer building to a breaking point for some.
Okay, so let's recap. We have manufacturers bleeding billions due to tariffs, trying to hide it or forced to admit it. And we have lenders bracing for consumers to default on loans. How did Wall Street react?
Oh, you'll love this. They reacted with euphoria.
Euphoria, seriously.
Seriously. GM stock shot up over 15%. Ford jumped over 12%.
They cheered this news.
It seems so. They cheered the narratives, perhaps, ignored the underlying data we just discussed.
Oh.
It was quite the disconnect, a total fantasy, really.
So the market celebrated while the data showed manufacturers getting gutted and consumers teetering.
Precisely. Which leaves you with a pretty unsettling thought, doesn't it?
Yeah. If the market is cheering a fantasy right now, how stable is anything, really?
And what happens when that squeeze we see hitting Ford's loan provisions fully breaks through? When those expected defaults become actual default on a larger scale?
That's the critical question, I guess. And now you, the listener, understand the data pointing towards it.
So there it is. GM hid the tariff pain behind an EV smokescreen. Ford inadvertently admitted the pain by using the word tariff 37 times in 55 minutes, averaging once every 90 seconds in their latest earnings call. They revealed the consumer is breaking, validated by the CPI report showing unbearable ownership costs. Wall Street cheered for GM's smokescreen and ignored Ford's warning. The data is undeniable. The great squeeze, driven significantly by tariff and policy uncertainty, is here. The domino effect we've been tracking isn't just theory. It's showing up in bankruptcies and in the earnings reports of the world's largest automakers. And we are continuing to monitor this. We have reports coming on the pre-Milan bankruptcy and the deepening cracks in the auto finance sector. As I keep saying, this is only the beginning. That's our show for this week. Thank you for tuning in to Confessions of an Insider. Find all the articles and data on theloganzone.com. Stay sharp, stay informed, and stay tuned. We'll see you next week.